Good day. Welcome to the continuing free mentorship by Thato Polelo from Polelo Trading Academy. I'm making this lesson particularly because the last time I wasn't able to record the screen like I had promised. Well, I did, just that it stopped after 16 minutes. The PC that I was using had limited space. So today we'll be looking at the topic, the power of three. That's accumulation, manipulation, and distribution. These are, like I had already iterated, that these are market profiles that the market moves in. They allow a trader to know what to do, what the market is doing, and what kind of trade to input. It particularly allows you to mark your PD arrays or your premium or discount arrays and know when to buy or sell. And then usually we would like to sell above opening price, Sunday opening price or midnight opening price, and then would like to buy below midnight or Sunday opening price. I'll elaborate more on the following slides. Stay tuned and let's dissect this accumulation, manipulation, and distribution thing. We'll be looking at the power of three in terms of visual aid or images, illustrations that will help you understand the foundations of this power of three thing that we're talking about. And now then afterwards go to the actual charts and walk through them, show you examples of the power of three, both in bullish and bearish scenarios. I'll try by all means to make this lesson as short as possible because we are going to a holiday and we won't be having that Sunday lesson unless everybody or anyone would like to engage in a lesson and a weekly outlook analysis of the trades of the markets that we'll be trading. So let's just get into it. In order for you to understand the power of three, it's best that we understand the bar charts. In the in our trading platform, TradingView, you should click on the bar chart. After this thing right here, just come right here, click on the bar candles, bar chart, or just the type of chart that you'd want to see. Click on the bars. These are the most accurate charts that you ever use when trading, just that they're not really attractive and appealing. So it's always best, if you want to be accurate with your analysis, maybe to toggle between these two and choose your bar chart. The bar chart is particularly accurate because it shows specific price levels, and this right here is a bearish candle. This is a bearish candle as a bar, as it would look in a bar chart. When you look at particularly, you just know that a bearish candle has an opening that is higher than the close. So this right here is where price opens, then price goes up, and then the high point of the price is the high, and then we have the low of the candle, and then we have a close. This is where price closes. Immediately after price closes, immediately after after a bar closes, another bar opens up, and then where the bar opens, it can continue. So if at all this bar closes at this level, and then another bar opens here and goes down and closes down here, it's another bearish bar. So that will mean you have a series of two bearish candles if at all this was a candle stick, but right now I could choose what it's a bar, so that's why I keep saying a bar. B-A-R. So this right here is a bearish bar, and this right here is a bullish bar. A bullish bar has an opening that is lower than the close. So the close is higher or on top of the opening. This is the opening point. Then you have the low, you have the high, and the close. And you must be wondering, why is this guy saying open, low, high, close? Why not open, low, close, high? No, it doesn't work like that. The market opens, creates a low of the day, and then, not of the day really, creates a low of the candle or of the bar, and then creates a high, then closes. Usually on a bullish candle, we always have, let me just say, we usually have the close a little lower than the high. And then similarly, on the bearish bar or bearish candle, the open is usually lower than the high, and then the close is higher than the low. That's how we usually have these candles look like. Now, with this in your brain, in your understanding, with this being studied, you should understand now when I get to introduce to you the power of three. Once, let's say the market is bearish, right? Then this is a bearish candle. Once the market opens up, it starts by consolidating. And then once it consolidates, it expands a little bit higher. And then once it does this, it creates a high. It then starts breaking down and creates a low. After it creates a low, it moves a bit high, or whatever expansion that it has, to now close. After closing, same process happens. But now if it so happens that the market does this on in terms of a bullish candle or a bullish bar, we start with an open, which is in terms of consolidation, and then we have price expanding below, and then causing a low. Once a low is caused, we expect to see an expansion higher, creating a high, and then a close, which we expect to see a close that will be lower than its high, if at all it's a bullish candle, right? Now, with that in mind, let's now look at the bullish power of three in terms of an illustration that is, if I would say, similar to the market, but the markets really don't move in this perfect manner. And the market is always in a jigsaw manner. It's always a mess. But this is how we always conceptualize the market movement. So, with that bar chart in mind, in that bar candle in mind, that bar in mind, the bullish one, actually we always have the open, the low, the high, and then the close. So this is how we would look. Right here at our open, we usually have consolidation, which is what we call accumulation. Accumulation is in form of consolidation. And then once this consolidation happens, we will have what we call manipulation, where price expands down, manipulating retail traders to what? To now think, okay, now we are selling. We put our stop loss right here. We go down. Our take profit is probably way down there. That's how retail traders think. But Rona, smart money, we are like, after having made our higher time frame analysis, and we have seen the market should be bullish today. If price does what it does here, we don't participate. We just wait to see the first signs saying this is just manipulation, and now we want to see price changing its state of delivery from being bearish to bullish. So hence why we call this area manipulation. And then distribution starts when now we have the most expansion of the day, of the week, or of the trading session, because this can be in terms of a day, of a week, of a month, really. So usually we want to see, when the market is bullish, we want to see accumulation in form of consolidation, price breaking down below the opening price. Let's say this right here is where price opened. This is, let's say, 12 a.m., right? New York time. And then I want to see price break down below the opening price. And then smart money knows what you buy below price. As much as you know you buy in discount, you don't buy in premium. So price will always give you a chance to buy below opening price. So what does price do? It manipulates retail traders. It manipulates retail traders that to think what the price is now breaking down, going low. Of course, you can trade this and make money, but still, now we want to get the most expansion of the day, right? Price breaks down. And then what do we have? We have our market structure shift. And then this right here is our market structure shift. Do we have a fair value gap here? We do get a fair value gap here, and this is where we enter, and then we take out our profits based on our risk to reward ratios. Now, when we look at the bearish power of 3, similarly, we have an opening, which usually, the opening is usually around accumulation and its consolidation most of the time. And then once we have consolidation ending, and then let's mark out our opening time. This is our midnight opening time or Sunday opening time. And then this is where price opened. This level that I marked out is where price opened on the, basically it's the opening time, right? And then we have accumulation in form of consolidation, and then manipulation, where price manipulates retail traders to think now we are buying. Although we are having a bearish day, right? We just wait for price to go above, to expand above a point in, or let's say we have a PD array that we are waiting for, and then now we want to sell, right? A bearish day means we are looking for opportunities to sell. Of course, you can buy and take out your profits up here. It's still fine. But now we are looking for expansion in order. It's going to be most of the day, right? So yeah, we have expansion high, which is manipulation. And then once price gets there, maybe it hits our higher time frame point of interest, and then we start now looking for what signs for price to break it down in form of market structure shift, which occurs right here with displacement. In that displacement, we should see a fair value gap, and then right here, this is where we put our entry, and our stop loss is probably up here or up here, and then our take profit is based on our risk to reward ratio that you allow yourself. So the goal of the power of 3 is to show us, if at all we're expecting lower prices, we want to see price expand higher, and then once we are above opening price, we sell. It's similar to the issue you're indicating. We sell in premium and buy in discount. So this is particularly like price being in premium and selling till you reach discount. Because sometimes, if at all you are selling from this point, your take profit could be exactly right here, below this area of accumulation. And then, or you can just place your take profit right where price opened, the opening price, the midnight opening price or Sunday opening price. This is where you could usually put your take profit if at all you sold up here. Don't worry, I'll show you examples on the charts. All right, now let's look at the bearish power of three in different perspectives in terms of candles um, and the expected price movement. So let's assume this candle is the daily candle, right? The daily bar. This is how the daily bar would look like. And it's a bearish price, bearish bar. So it's a bearish day, right? So, like we said, the opening of the price. So you said this thing right here. This is the opening. So at the opening, we expect to see a measure of consolidation. And then after consolidation, what do we get? Manipulation. Manipulation usually creates the high of the day if you're looking at it in the perspective of a daily time frame or of a daily range. A daily range is like the difference, the length or the difference between the high and the low. That's the daily range if you're looking at it that way. You can look at the daily range on different time zones: 15-minute time zone, 15-minute time zone, 1 hour time zone, 4 hour time zone, time frame, not time zone. 1 minute time frame, 2 minute time, as long as it covers from midnight until midnight the following day. So this would be the daily range. So a dealing range is a price point from this high to this low, this high to this low. That's the dealing range. So looking at this, what do you call it, bar, the opening is at accumulation, and within accumulation we expect to see a measure of consolidation. That's when price goes up down in a limited range. We don't see expansions such as this in the market. So price has accumulation, and then it manipulates high, causing the high of the day if at all we're looking at a daily standpoint. And then after creating the high of the day, which is this movement up, and then this movement up to another manipulation. Buyers, so we have buyers up here who put their stop loss somewhere here, thinking, today we are buying. It's a buy day. We are going up. But no, that's why it's called manipulation. Price, it's giving us the smart money or SMC, smart money concept traders, to start now putting our sell positions around here. It will depend if at all we have maybe a PD array right here, right? Then price goes up and then gives us opportunities to sell in terms of market structure shift, displacement, and then fair value gap within displacement, and then we hit the sell button when we get to that fair value gap in displacement. And then once price breaks down, that's what we call distribution. This is the D right here, distribution. And then your take profit should probably be placed where, I don't know, another PD array, or placed on based on your appetite of taking profits or risk to reward. And then usually what does price do? It causes a low and then comes back up, does a little bit of consolidating and then closes. So even if you look at it as a candle, this candle right here would look like this if you look at it at a perspective here, where if this was a daily candle, the daily time frame candle, if you go down to a 15-minute time candle from midnight until let's say this is midnight, Wednesday midnight, and then right here on the 12 a.m. or Thursday, this candle will look like this. This candle will look like this. Why? Right here is the opening, and then when price does the manipulation, this will be the high, and then distribution down, and then it will cost the low of the day, and then price will move a bit up and then close at this level. That's why you see candles being like this, having wicks. So these manipulation and price going down right here, causing the low of the day and causing, what do you call it? This consolidation and closing. Price would look like this. There would be the body of the candle, the wicks. This is manipulation, the high, the low, the open, the close. So if I were to label this candle, would have the high right here, would have the opening right here. Like I said, on the bearish markets, or a bearish candle has an open that is higher than the close, and then would have the close right here, and then would have the low right here. So we have OHLC. So that's why sometimes bar charts are called OHLC charts. So if I were to give you homework, please take a screenshot of this. If at all you are using a PC, or even if you're using your phone, take a screenshot of this little chart. Mark out, draw out where the accumulation is, where the manipulation is, and where the distribution is, and then you can send directly to my Telegram, and then I'll assist where possible. Now, looking at a different perspective now of the bullish power of 3 perspective, we have the opening of the bar candle, or even the bar, or just the candle, being lower than the close. So what usually happens is, when, let's say this is a daily candle, and you are looking now at the daily candle at the perspective of maybe the 15-minute time frame, we have the opening right here, which is right here, and then within the opening, we expect to see a measure of consolidation, which is accumulation. So this is the accumulation or consolidation happening, and then let's mark out our opening price right here. This is our opening price, right? What happens? Price breaks down, manipulating retail traders, or now we are selling, while in actuality we are not selling. We're just looking to, it's just the market, the algorithm giving us, tapping our hands, Rona, the retail traders, tapping our hands. Now it's time to start looking for buying opportunities. Why? Because you only buy in discount. You only buy below the opening, below the opening price, whether it's the daily, the midnight opening price, or the weekly opening price, or the Sunday opening price. So if prices, we're expecting bullish prices, we want to see price go down, and then that market structure shift of ours that we always look for, then maybe our FVG is right here, right? This is our FVG, our fair value gap. This is where we buy. You can buy anywhere below opening price. As long as it's below opening price, even if maybe price comes, let's say price comes, and then you were not able to enter initially at this point, and then it usually comes back down, close here, and then this would be another opportunity for you to buy. And then if at all you miss this point, it will again come close to the opening price and then rally up. So sometimes the market gives us opportunities. If at all you miss this point, it gives you another opportunity to buy. So note this down. You can buy, if at all the market is bullish, you can buy close or below the opening price. This level marks the opening price. If at all this was the opening price here, so here it is. This right here is our opening price. The midnight price. This is our daily candle, and this is our 15-minute time frame view of the daily price movement. Opening price here, 00.00 a.m. New York time. All right, I get it. And then you mark the daily at the opening price with a horizontal ray. The horizontal ray, you'll find it right here. The horizontal ray, that's where you get it. And then once price breaks down, touches maybe a level you start looking for an opening or opportunity to buy, you buy below opening price or close to it. It might be a little bit on top or a little bit below, but initially below opening price. If at all, maybe the kill zone is already while price is above opening price, but it's close to it, you can buy. You can buy it, or you are targeting at the top here, somewhere there. Where I know you are targeting risk to reward, 1:3. So 1:3 is something like 1:3. 1:3. So let's say opening price here, and then you had an opportunity here. So 1:3. 1:3. 3.2. 1:3. This right here is 1:3. So you don't really necessarily have to be always chasing the highest point of the market. Nobody can. It's I tell you, you might maybe touch it out of luck, take your profit there out of luck. Maybe somewhere here, or before even the high was reached. You never know where the high would be. We only have the high as being where price might turn, fair value gap there, or some sort of resistance at the top there. So yeah. So this is really the bullish point of view, bullish power of 3 point of view or perspective in different charts. So with that being said, let's look at the actual chart walkthrough to give examples of the power of 3, both for bullish and bearish markets. All right, looking at the charts, we'll take a look, start with a bearish standpoint or a bearish market in order to give you the bearish power of 3. So I would like to start by looking at what bearish day was. This one is happening right now, so I can't use this candle. I want to use something that's already happened. Yeah, the hindsight guy. I use the hindsight data that's already happened. Let's see, this Wednesday 26 June. So look at it. So a candle that is bearish has an opening that's higher than the close. So the opening is here, the close is down here. So the high is here, the low is here. Even if you look at it at a perspective here, the bar chart, this is how it looks. This is it, 26. Open, high, low, close. Change it back to candles. Open, high, low, close. This is a close. So I expect for the markets to behave like so. Accumulation. This is consolidation. And then we have manipulation up, causing the high of the day, and then distribution down, and then causing the low of the day, and then price going a little bit high, and then consolidation, then close. Now let's go down to the 15-minute time frame to look at the daily price range. Yeah, the daily price range, looking at it using the 15-minute time frame. So I'm going to be looking at the 26th of June. So using the 15-minute time frame. Let's see, reset. All right. So I'm going to mark out Wednesday 26 midnight until Wednesday 27, Thursday 27 midnight. So this is the daily standpoint of the markets based on the daily standpoint of the daily candle. I get the daily candle in terms of the 15-minute time frame without having to just look at one candle. Really like the 15-minute time frame, yeah. So each and every candle that you see represents 15 minutes, right? And like I said, I would expect to see something like consolidation, then manipulation up, then price breaking down, and then price going up a little bit, and then manipulation, I think consolidation, and then close, right? So first of all, I'd like to mark out the midnight opening price. This right here, this candle, you know what, tomorrow, Wednesday 26/00/00. That's midnight. The opening, a bearish candle king, it's at the top again. So which is here. This candle, this one, Wednesday, the candle here Wednesday 00, right here 00 at the 12 midnight. So the opening of a bearish candle is always where? At the top, and a bullish one is usually at the bottom. The closer thing is at the bottom. So what do we expect to see, Kana, when we are selling? When we want to sell, we want to see manipulation. This is manipulation. This right here is manipulation. Although we don't see a rapid movement or a exaggerated movement up and then down. This on its own is manipulation. So what do I want to do? I want to either sell above or close to the midnight opening price, right? So this is midnight, and then this is midnight right here. This right here is our opening price. So I want to sell above or close to the midnight opening price. What happens? Price, this is consolidation. So if I would mark it out, this for me is consolidation. Manipulation out right is really, really small. This is manipulation. And then this is distribution. You can mark the rest of this as distribution, that's fine. But I like to mark distribution as the highest movement, the longest movement, the biggest expansion of the day. This. Let me mark it out. Accumulation. Manipulation. And then distribution. Okay, accumulation, manipulation is where price seems like, now we are about to go up there. But on a day like this, I don't think a lot of traders would be manipulated unless they are trading the what do you call it, the lower time frames, right? So this is our accumulated manipulation. It's not that much. It's not really that much, don't wanna lie. And then we have distribution down until this point, and then this is our close. So hence why I was expecting to see something like this is accumulation. Then let me do it along this opening price. Accumulation out of 9, and then manipulation level, and then what do we get? Distribution, and then price closing. So this is how it looks like. That's why those drawings of mine, the initial drawings, they are really perfect, but it's not the way the market moves. The market moves in a really confusing and zigzaggy way. So it's best you get yourself used to such things. So if at all you see a day like this, let's say now 12 a.m., or you can even come to the markets when it's time 2 a.m., and then you come and mark the midnight opening price. When you are trading the hormone, the what do you call it? You are trading the you are trading the New York session. Why you don't participate on all of this? You only want the New York session, and this is the reason why I only trade the New York session. Look at London session, Asian session, London session. Yeah, well, there's a bit of movement, but what do I want to see? I want to see this. I want to trade this. Of course, you can trade this. You can trade this. It's fine, but now I want to trade this. Most of the movement is usually on the New York session. That's why I specialize on the New York session, on the Nasdaq and S&P 500, and even gold. That's why I trade this. I don't want to trade price action that looks like this. This is consolidation that I don't like. So, if at all, I was going to trade this, I would look at the fact that, okay, I want to trade between 830, that's for Nasdaq. If you're trading the Forex, like your Euro, USD, your GBP, USD, you trade, your kill zones should start from 7:30 a.m. until 10 a.m. And then since right now we are trading the indices, that's your Nasdaq and S&P 500 and commodities such as gold, we trade between 8:30 until 12, but now I trade between 9:30 and 11, just to specify really what I so that I don't spend a lot of time in the charts. But I'll do this at a perspective. So let's mark 8:30. Here we are. 8:30. 8:30 is right here until 12, right? 12 right here. So where would I go? So first of all, I'll start looking at price at 8:30, looking for my entry, right? So far, go diragetse accumulation, manipulation, and then what do we have? You should always analyze price from previous information, previous data. You can see how price got into a fair value gap, or how is just price getting to a fair value gap multiple times, giving you a chance to sell. Well, one is giving you a chance to sell above the, what do you call it, the opening price, above it. Even here it comes. So if at all I was to sell during the kill zone between the 8:30 a.m. and 11, this is where I would sell, right here. Let me mark where I would sell, right here. This is where I'll put my sell entry, right here. Why? Because look on again, it's still touching the fair value gap. You see that fair value gap, multiple times, giving you chances over and over. Somebody who hasn't taken a sell trade right here, I don't know what you want, but yeah, this is price giving you multiple chances to sell. Why am I saying this? Look at this. There's a market structure shift here. Where else do we see a market structure shift? We would see, okay, let's start using this scenario. A high was taken out. That's liquidity grab, and then we have a breakdown, and then a swing low. This is a swing low right here. You can use the swing low. You can still use this one. It's still fine, but still, it still has what? displacement. There's displacement here, there's displacement here, and there's the formation of fair value gaps here, fair value gap here, fair value gap here. Yes, I will for me the price still, even if I use this one, I would have used this one still. Why? Because it's in premium. Look at that. Premium. It's in. I would usually use this one because I don't like to use the one saying or hardly more premium. Half of it it's a more premium, half of it it's a more a part of it it's a more discounting. I don't want that. I want to see one that is fully in discount, I think in premium, if at all I want to sell. My trade would look like so. I would enter right here, my stop loss would be here, and then my take profit would be probably 1:3. Risk to reward are 1:3 right here. Or if at all there's a low somewhere here, I'll target this low. I'll probably target this previous low. This one. Did we take out that previous low? Yes, we did. Right here. So my take profit would be here. This is where my take profit would be. So particularly the power of 3 helps you to have a sort of like a blueprint there, your trading plan. If at all ke sell ke tswa kae? Am I coming from here? Ke ya kwa tlase? Kana from up, based on your analysis. Am I expecting a daily, I think a bearish, am I expecting a bearish day? Yes, I'm expecting a bearish day. What else can support this could be a bearish day? The fact that price starts by consolidating, which is accumulation, and then going above the opening price, midnight opening price, I get it, and then now from the midnight opening price there, above the midnight opening price, I start looking for entries, for opportunities to sell, right? Even if it's close. So I want to came close, and look at how the market reacts to the midnight opening price. Most of the bodies of the candles close below the opening price. Can I get opening price this one. This is the open, the close, the high. This candle right here. I want the opening price arrow. Look at how most of these candles, bullish here. This bullish candle, it even tried to even close the body. I think the open. I think this. The bodies of the candles tell the story, and the wicks do the damage. This is damage. It did the damage. It came and touched the fair value gap, and then ran down. Even in this fair value gap. Look at how price was not, the bodies of these candles were not closing above this fair value gap. This gap between this and this candle. Why about this gap? This low of this candle, this high of this candle. These candles were failing to close above this level right here. It would give me more signs that when price is going down. So that's what I want to see. And that's why I would happily put a sell entry right here and then take out profit right here. You take out your profit based on what? Your previous lows. Now, we are going to look at the bullish view of the market, the power of 3, right? We were looking at the bearish one, the 26th of June. Now we have a bullish day on the 27th. That was Thursday. So look at the candle at there. The open of the day is below here, and the close is up here. Hence why it's a bullish day. And then the low is below here, the high is here. So there's not going to be much manipulation as just like the previous day. A lot of manipulation, I think, wasn't that much. So Let's look at this day. I'm on the daily time frame looking at the candle, the Thursday 27 June. Let's look at the perspective, 15-minute time frame. That is what I'm doing right here. So Raumaka, the midnight price from the 26th until the 27th. So the opening price out on from the 27 to the 28, I think. Let's see. Yeah, to the 28. So when you look at this is the midnight price. So the midnight candle, it's a bullish candle. So a bullish candle has an open that is lower than the close, right? So I'll use my horizontal ray, and this is the opening candle. Sorry, the opening price of this day. So it's the midnight opening price. This horizontal ray marks our midnight opening price. And when you have done your analysis, no, this day is going to be a bullish one. This day is going to be a bullish day. You expect to see price movement in here. Consolidation, manipulation down, then distribution up, and then price goes a little bit down to close, and then consolidates and then closes. That's how I see it. So that's what I expect to see. Consolidation, price moving down, and then price moving up. Now I want for price to move down, and then I start looking for what? Price going up. One thing that I would like to mention that is worthy of being noted down. Make sure you don't only look for price to get into fair value gaps for you to start looking for an opportunity to buy, or to sell. But since we're talking about buying in this scenario, you don't look for price to maybe get into a fair value gap below here or below, or you buy. Like I said before, I start looking for opportunities to buy or sell once price takes out liquidity or a previous low. Since you are in a scenario you have to buy, I wait for price to take a key low. Why do I say this is a key low? It will probably appear in the higher time frames. It will appear in the 1 hour time frame, the 4 hour time frame, and even the daily sometimes. But if it appears in 1 or 2 time frames, for me it's a key low. But if this one, like this one, it has relatively equal lows. Look at these. There are a lot of people who put their stop losses here, and price came down, took that low, and went up. So before price has a significant move up when you want to sell, when you want to buy, expect these kind of lows to be taken out. Where you see relatively equal lows, expect this to happen. Price taking the low and then going up. Look at this movement. Look at that. This is what I expect to see. So what do we have here? We have consolidation. We have manipulation. And then what do we have? Distribution. Distribution. Of course, I can take a huge loss. You never know these things. Manipulation at the end of affect the smart money concept trader. It's still fine. You have another day to trade. So what happens here? I don't think I don't have enough, but I do have enough information to explain to you. But if you go down to a smaller time frame, the 5 minute or even the 1 minute, you see clearly exactly what's going on here. But of course, from the opening price, we see, what do we see? We see consolidation, that's accumulation, with consolidation, and then manipulation down. After price takes out these lows, what do we see? To buy. Price went down to below the midnight opening price. So if it went down, it goes down. You can go down to even a smaller time frame, 1 minute, 2 minute, 3, 5 minute time frames. Immediately when it takes these lows out, some aggressive traders, by now, they know what they're doing. They've been doing this over 20, 30 years. Once it takes out these lows, they buy. Buy it the previous high of the day. That's why when I was analyze the daily time frame, I mark the high and the low. If at all I'm sure that maybe the day is bullish, I mark to take my profits at the previous day's high. And then look at this. Price takes out the low of the candles, these relatively equal candles, relatively equal lows. That's where a lot of liquidity resides. And then what do we have now? Market moving up. And then we have market structure shift. You can use this as your market structure shift. It's still safe. You can use this, still safe, still fine. This could be your market structure shift. And then when you use this as your market structure shift, what do we see? It happened with displacement, right? What did we learn? Or when it happens with displacement, what do we look for? We look for a fair value gap within that displacement leg. So within this displacement leg, we have a fair value gap. This is the fair value gap. This is where you would put your take profit, your trade. This is where you'd start pressing those buy buttons. And then why would you buy here? Not, if at all you didn't buy below here, you'd buy here. Why? Because it is close to the midnight opening price. I wouldn't buy here. I wouldn't buy here. If at all I do buy here, somewhere here, of course, price it's going up. It's bullish. Now I would use this as an idea. We are in a bullish trend. So I'm trying to buy. I would buy here, going up. I would buy here, I would buy out. There are a lot of opportunities for you to buy, but this one will be the most perfect opportunity to buy. If at all you're a person who trades the London session, because this occurs in the London session. Like I said before, the London session is between 2 a.m. and 5 a.m. EST. So my trade will look like so. My stop loss will be low here, and then my take profit will be a risk to reward ratio 3, 1:3. But if at all you are a person who trader they're trading to take out the previous day's high, this will be you. But me, I always suggest trade in a safe way. You can always use a previous high, not necessarily previous day's high, as a take profit level, especially highs that have relatively equal highs. When you are buying, look at these highs. They're relatively almost equal. That's why they're relatively equal. Why? Because I'll use this because there are people who've put their stop losses up here. Stop losses up here. Because when the retail trader that believe when they see a lot of resistance, that's where they buy. Or now we buy based on price action. The price was getting into a fair value gap and then came down, market structure shift, another fair value gap. I use that as an entry, take my profits down here, based on a take profit that I make a low, a previous low that was formed, which is a key low. These ones are relatively equal highs, and this is where I would take my profit. And this is the safest place also to take profits. Why? Because the algorithm is going to take out people here. The algorithm is looking to take money from you. It's going to take your money. If you think you are special, you are not. You're only going to be special if you use these concepts, these smart money concepts to make money. We take money from the other people in the in the market. So this is how you would take your profits. That's why you wouldn't have to mark to try to take out the highest high of the day. We don't know where it would be. Maybe it could be at this fair value gap. But it didn't even reach that fair value gap in this day. It reached the fair value gap the following day. One of this candle right here. It touched the fair value gap and then quickly went down. But then because of the higher time frame narrative, it's going to go up anyway. To what? To take out this high. And price took out this high because these are relatively equal highs, and there's a high also here. This high is not even they're equal. This high and this high. So if at all you were trading from this point, you will target these highs. Or at a high, or you will not trade from here until here. You'll be targeting these two highs. And look what happened. Immediately when price took these relatively core highs, it ran rapidly down. That's why I get it. Look for price to take key lows or relatively equal lows or relatively equal highs or key highs for it to have some sort of a significant move. So now I'm expecting to see a significant move down. So I think this wraps up our lesson on the power of 3, and I'll move on to now a lesson reinforcing the order block theory, so that we can now understand and know the order block theory, taking trades based on your order blocks and taking aggressive trades. So, sometimes you don't even need to see a fair value gap, just an order block is enough. I hope you found value in this lesson, and I hope it helps you better your trading journey. Until next time, bye-bye.